Hello, everyone, and welcome to the Cash Flow Connections Real Estate Podcast. I'm your host, Tyler Lyons, and I'm very excited for the guest we have here today, who's actually a repeat guest on the show and a longtime friend of the show and of ASIM Capital. So I'm really excited to have Mathew Owens back on the show. He's the CEO at OCG Properties, where he helps clients attain financial freedom. And on his previous episode on the show, which is episode 600, we had an excellent and exhaustive discussion on how to raise capital from foreign investors. So if that's something that's interesting to you, make sure you go check out that episode too. But Matt Owens, welcome back to the show.
Thanks, man. I appreciate it. I always love being here and having good conversation. Different topics, different strategies to implement.
Most definitely. Yeah, really excited to dive in with you here today. I know we can take this conversation today many different directions given your background and everything that you know. But before we get started here, why don't you give the listeners just a little more color on who you are and what you aim to achieve at OCG Properties?
Yeah, absolutely, man. Thanks so much. So I'm a CPA. I quit my CPA firm job in 2006 to go into real estate full time. Was a real estate genius for about a year and a half before I got my ass handed to me by the market crash in 2008. And then, since then, we've actually flipped a little bit over 1,000 houses. We have a little bit over 35 million now lent out to flippers in different markets around the country. I've raised a little bit over $150 million for real estate transactions over that last 15 plus years. And have lots of bumps and bruises and black eyes along the way, just like any real estate investor does, of course. And at the end of the day, right now, what we really focus on and really look to achieve is creating that financial freedom through different syndication type investments, whether that's related to debt, whether that's related to property investing, single families, multifamilies, self-storage, mobile home parks, all different types of a variety of investments. And then we even work on individual projects and individual smaller projects with individual investors and help people with 1031 exchanges, with replacement properties, help them, teach them how to raise capital and different strategies like that. So it's a lot more fun than doing accounting work at a CPA firm, even though, as you and I were discussing, it is a lot harder sometimes, right? You get that punch in the face every now and then to remind you that you don't know crap yet and you're still learning like everybody else, right? So
That's such a good point. Yeah, I'm glad you brought that up too, because if you're in this game long enough, you are going to have bumps and bruises. There's just no getting around it, right? It's kind of part and parcel of this particular industry, especially right now when we're in the market cycle that we're in right now, where things have really changed quite a bit the last couple of years here. So I think that might be a good starting point for the conversation here, Matt, just to get your perspective around, when you look at the broader economic environment right now, in your words, how would you describe that? Like, why is it challenging for real estate investors out there right now? I'd love to hear you just kind of elaborate on that.
Yeah, absolutely. Well, I mean, we've had a significant amount of changes, right? In that a lot of operators may or may not see out there. Some of them are a little more hidden, or misunderstood, and some of them are, very clear. Like, for example, the interest rate environment. What happened was, obviously we have very low inventory across the board in multiple markets. That doesn't necessarily mean there's demand either, though. And so because you have massive interest rate increases, it's squeezing affordability further, making people not want to sell their homes because they're on 3% mortgages historically over the last 10 years. I don't know, a lot of people that are not selling at all because they're like, why would I do this? Even if it drops back down to in the fives and stuff like that, you might get some people moving, but you still have a lot of people. That 2% decrease in rate is a massive payment difference on the pricing of the house that they can acquire. So you've had some major changes on normal single family housing, and because of those interest rates and because of the lack of inventory on the market, which the interest rate rise exacerbated that problem further, of course. And so you kind of have a broken market. It's harder for investors to get things to pencil, both in the regular single family home rental market, but as well as the multifamily market, to make sure that things pencil out. And you're seeing a lot of distress in that area that may be coming because of a lot of refinances. We'll see what happens with interest rates. We'll also see what happens with rental increases. It's very, very dependent on the market as a whole. Every market is completely different, right? But you're seeing major swings and changes because of some of these factors, on top of potential economic catastrophe from a million other risks that are occurring right now at the same time, right? The war that's occurring, the political climate, usually 2024 or an election year is usually going to be a little bit stabler or better because the politicians want to make things look good for themselves, So, but at the end of the day, there's a lot of risk out there in different ways and distress in the overall market. And a lot of the numbers have been skewed to make them look better. And so it may not be seen to the typical real estate investor, out there. And so through that climate, I think it's very much time, just like I had to do in 2008 when I got punched in the face, is to stick and move and start to make changes, start to look at additional income streams and diversify a little bit so that you don't have risk in a particular asset class fully, right?
Mhm.
Yes, you got to take risks in multiple asset classes, strategic risks, but or on one particular asset class that you specialize in, but you can also diversify into different income streams as well to significantly increase your chances of weathering any storm. I think it's a defensive play right now in the market. As a whole, you got to play defense before you play offense. At the same time, and you should be looking at all your investments that way. At the same time, there are significant opportunities out there right now, even with all the turmoil that's happening. It actually creates better opportunities with turmoil. So you make more money in a down market than you do in an up market.
Yeah, I think that's a great summary, Matt. I can't disagree with anything you said there. There's a lot going on right now, a lot of risks in the market right now that need to be just kind of gauged and carefully measured. And I do agree with you too that, hey, look, in times of the market cycle right now where it is scary and it seems like the risks are stacking up and interest rates are high and people are worried, those are typically the times of the market cycle where there are good opportunities to be purchased when people are scared, when it's tough to find deals. Those usually end up being good buying opportunities. And, we talked a bit about risks and challenges and some of the things that are going on in the market right now. And I definitely want to come back to the discussion around diversification. So let's definitely come back to that in a couple minutes here. But in terms of, from a challenge perspective, what kind of challenges have you faced, at OCG Properties the last couple of years here? I'd love to hear you elaborate just on how things have kind of went for you, and what kind of is that creating any changes in your business specifically?
Absolutely. I mean, there's every time there's a problem that gets solved or a loss that gets taken or, a punch, you change. You have to implement the right procedures. Otherwise, it's going to continue to happen again. I've been actually stolen from multiple times, to the point where, it hurt. I had a contractor steal about $400,000 from us, plus, which ended up costing me, close to $1 million fixing all of those problems and redoing everything all over again. And there's a lot of projects going, of course, for that kind of a loss. But you take those types of losses and you have to just push through, right? And keep your head up and keep moving forward. We've had multiple instances where there was theft or a bad team member or a change we had to make. And I swear sometimes you're dealing with 12 problems before noon on a Monday going, oh my God, how do I deal with all this? And it's just a matter of getting your mind right. You have to be able to say, okay, what action items right now can I take to move this forward and be able to succeed and solve the problem, and then also, how do I make sure that doesn't happen again? What are the things that I need to do to protect myself going forward on all team members? What did I do wrong that cost that? Because it's easy to go through and say, oh yeah, someone stole money from me. I can't believe they did that to me. Yeah, but I let it happen, right? I didn't have the right procedure in place. Well, I actually did in this case, but at the same time, it wasn't followed correctly. And it was because, I was too busy. My team was too busy. We're focusing on, on the whole system as a whole and not that one particular deal because there was trust there. I swear it's the people that you feel like you can trust the most that screw you the most. So you got to be really careful and still do your homework. Don't deviate from your procedures because there's trust there and you think that, there's no way this guy's going to do that, and or that person, right? And I got to look in myself and as a business owner, that's if you are not able to look at yourself for the things you've done wrong and take a step back and say, damn, that's on me right now. No matter what happened, no matter how much easy it is to blame somebody else that did something wrong or wronged you, if you can't look in yourself and say, what could I have done differently to make that change? And what do I not want to do again? Then you're doomed to fail as a business owner. You're not going to grow enough to be able to make that happen, right? So there needs to be some major self-awareness that you go through to be able to realize that, and then get past the pain, because that doesn't do you any good to sit there dwelling in the pain. You have to look up and say, what is this going to do for me going forward? It's making me 10 times stronger. It's putting me in this position to be able to, not have to deal with this anymore, not have these risks. There's and actually a ton of new income opportunities sprout out of those types of, temporary defeats or punches that you take. And it's kind of amazing, because when you're focused on the solution and how do you solve it and make money versus letting that pain dwell within you, you are able to make 10 times more money and see more opportunities readily available to you than you've ever been before, because you're open to it. It's like, I told a story one time about how I was about to lose like $50,000 on a multifamily building that I just way underestimated the rehab, which happens a lot right now. Another risk in the market because of inflation and changes, right? But we underestimated the rehab, and we were going to sell it, and I was going to lose $50,000. And back then, that was a much bigger deal than it is now. To me, that's still a big deal, $50,000. But like, that's a salary. And I remember going to my wife saying, "Hey, put your hand on my chest. I can't breathe. I just lost a salary today. Like, what am I going to do? Like, I can't believe that I got to dig out this $50,000 hole, from this one deal." Right. And the next morning I woke up and I was like, you know what? I'm going to figure this out. How do I make this back right now? How do I go through and push forward to make this back? And I found another deal that I got under contract. I think it was the next day. I was working on that deal that day, and I got it under contract the next day because I'd already seen it come up and had done some analysis. And I was like, let me go after that one. And then I had a 1031 exchange buyer that needed to buy another multifamily building, and I ended up doing a wholesale to them and made $70,000 in like 2 to 3 weeks in that transaction to make it all back. And when that occurred, it literally put a switch off in my head where I was like, oh crap, look what happened when I changed my negative focus to the positive opportunity focus. And it was like, when that happens, it makes it a lot easier in the future to take those punches and just let it, even though it hurts still, but just let that go and focus, right? So on moving forward. But yeah, it's a tough thing to deal with, and taking those hits.
Yeah. Yeah. Those really helpful perspective there, Matt. And it really, I think something important too there is that, it's interesting hearing about how, back in the day, maybe several years ago, a $50,000 mistake really bothered you. And now here you sit, you're talking about $400,000 mistakes or $1 million mistakes like it's no problem. So it's interesting to hear that kind of
I
mental
don't
shift that you've made over the
I
years.
don't want to feel that way on about $1 million mistake or four hundred
Yeah.
thousand dollar mistake. Trust me. But
Oh, totally.
it's something that you have to emotionally have your emotions under control. Like
Yeah.
I talk with my brother about this, which is my business partner, quite a bit, going, wow, we were beat up, pretty good. Like, it's pretty amazing what we've been able to get through. And we still have our initial reactive behavior sometimes to an issue that comes up, and then want to then dial it back and be like, okay, let's put that in perspective. But it's a matter of how fast can you not be reactive and focus on being proactive instead, to that particular thing that comes up, and how do you solve it? Because then if there's a solution, you're able to get rid of the emotion out of it as well, and say, yeah, there was a problem. Oh my God, all the million things in my head that I thought were going to go wrong aren't now, because I have a solution. Here's the worst case scenario, very clear for me to see, right?
Yeah.
So
Yeah, that's great. And I mean, in the world of entrepreneurship as well, your ability to solve big problems, the bigger the problem you can solve, the more success that you're going to have. So, yeah, kind of hearing you solve for smaller problems and like solving for bigger problems, like as entrepreneurs, that's something that we should all aspire to, is to be able to kind of calmly solve bigger and bigger problems as they arise. So kudos to you on kind of battling through those challenges, and also for, your openness on sharing those challenges with us, because we're at a stage in the market cycle right now where people are facing a lot of stuff. And I
Right.
think oftentimes entrepreneurship can be a pretty lonely place. And people sometimes think that, hey, look, I'm in a vacuum. I'm kind of in this all by myself. Like nobody else is going through this right now, but there are people going through a lot of stuff right now. So yeah, just
Yeah.
kind of hearing your story on that, Matt, I really appreciate you sharing it. It's super duper helpful.
Yeah, social media is not representative of real life. Not everybody is just swimming in money all the time with no problems at all, and driving yachts and sports cars, and you know what I mean. So,
Absolutely. Yeah, it's definitely real life stuff in the world of entrepreneurship. And I definitely do want to pop back into the discussion around the market right now. You gave a really good analysis of like, hey, look, here's why it is challenging right now. Here's kind of what happened. But as you look forward into 2024, like what's your market outlook for 2024? Do you think things kind of bounce back a little bit? Do you think we see interest rates come down a little bit? Like what's your outlook on 2024? Is it rosy? Is it more pessimistic? I'd love to hear your perspective.
So I think it's a proceed with caution in my eyes. At the same time, I think we've seen some corrective behavior to the overall real estate market for as well, to be able to mitigate risk in real estate. Where, for example, in multifamilies, and you and I were talking about this specifically, there's been a correction already built in, because if you're a buyer, you can't buy at what the previous pricing was based on current interest rates and make it pencil for your investors and for yourself. So if you can get a 20% discount on a property because rates went up, significantly, and the math doesn't work, and still do a value add to protect yourself in a good market, you're going to be golden. The underlying metrics are really matter right now. I think the bigger risks of real estate in general are wages and what's going to happen with affordability, because it's a matter of, are wages going to continue? Right now, it's very difficult with very low supply for you to have a major crash that occurs, right, in the overall market. And is supply going to come on in the single family space if interest rates drop a little bit? I believe so, to a degree. It might be a more healthy market as well. But I also think people's affordability might go down if we end up in a recession. We have inverted yield curves and things like that right now that are always a signal of a recession. And so if we end up in a recession, are wages going to decline, or are they going to still push forward with inflation, or the inflation adjusted going to reduce? Because people don't talk about true affordability. They talk about affordability when it comes to rents, and monthly mortgage payments, but they don't, and credit cards and things like that. But they don't talk about food prices, gas prices, and things like that that really affect affordability at the end of the day. And are people really truly going to be able to afford the housing and the increases, and is it going to keep up with inflation on the rental side? Usually in a recession, rents drop. And so being very careful on your acquisitions to say, yeah, we might have this much room on my value add to get to this rent, but let me make sure the math works with a 10% reduction in rents, or 15%. Am I break even? Am I making money? Am I making an okay return still, or decent enough, even if there was a crash? So looking at what the downside risk of is on those deals that you're working on is super important. But if you find those, oh man, it's incredible. Like we just closed on a 172 unit mobile home park in Topeka, Kansas, that we were adding 52 new units to empty slabs, and we're rehabbing 26 vacant units that were park owned homes, and we're ending up after the value add stage at a 13.8% cap rate. So incredible, major value add. Need to have the right team that knows what the hell they're doing to do that value add correctly, and have the right resources, because that's a bigger risk on a deal like that. But I look at it as a major equity protection play, because if those things are trading at a 6.75% cap rate now, and I'm at a 13.8 cap at my cost, I'm doing that's amazing, right? And then in addition to that, if we have to refinance, we're bumping interest rates up on their projections to make sure that those refinances correctly on the back end, and we're being conservative, and we're bumping up cap rates on the back end exit to say, hey, If cap rates, get worse, and all of a sudden that 7 cap turns into an 8 cap, let's pretend like we're at 8 cap on that sale at the end of 5 years to, pretend like the market crashed. Are we still okay? Are we making money, at that point? Then great, let's move forward with the deal. And, but so it's a matter of looking at the risks of the market, finding ways of mitigating those risks, and using your financial modeling to be able to predict and understand what would happen in these scenarios if these risks occurred, so that you can mitigate those as best you can in your acquisition decisions and your project. This is what I love financial modeling so much. I have two 47-inch screens behind me so I can have Excel open across the board and do financial modeling. But it's a lot of fun. It's amazing what it can show you.
Definitely. And as somebody who's also, has a CPA background, I'm definitely sympathetic to nerding out in the financial models. And it is really important too. You touched on doing a sensitivity analysis. Any good sponsor should have a sensitivity analysis that they can share with you. If you're an
Right.
LP out there looking to invest, definitely take the time to examine that sensitivity analysis. Typically it's going to show what happens to project returns if you start to adjust the dial on some of the key assumptions in the financial model for that particular opportunity. So, okay, we've got modeled out average 3% rent growth. Well, what happens if we're at 1% rent growth or negative rent growth or 0% rent growth? What
Right.
happens if our exit cap rate ends up being 6.5% instead of 6%? Like really
Right.
taking the time to understand, examine, and analyze a sensitivity analysis, and ask the sponsor too. If you don't understand elements of it, really make sure that you take the time to understand it, because in a market cycle like we're in right now, when things are changing fairly rapidly, it's really important to really bear down on those key assumptions and make sure you understand them in a ton of detail.
Yeah, and I think some of the other things to really pay attention to are making sure you have extra cash reserves for projects taking longer for economic turmoil, the or potentially increases in supply costs. If there's a war that occurs, or more than that than currently or here in the US, it comes here at all, there could be major supply chain disruptions, and there probably will be at that time, which means it'll take longer to get your stuff in. It'll cost more money, just like what happened during the whole, COVID pandemic thing that they, pretended occurred. Uh, they at the same time, we had supply costs going through the roof like crazy, because we couldn't get, took 6 months to get high-end appliances into projects, and it was really hard to deal with. And so being prepared with extra cash reserves for extra timeline reserves and things like that is really key, and structuring your debt stack so it can withhold, or withstand that, interest, or that rent drop or something like that, or interest rate increase, is absolutely key to long-term performance.
Yeah, great points, and definitely things that are really important to consider right now at this stage in the market cycle. So we've covered a lot of ground, Matt. We talked a little bit about why the market right now is a little bit challenged. We've talked about challenges that investors are facing right now. We've talked about what it might look like going forward here. So kind of when you roll all that information together and think about where we might be going in 2024, I'd love to get your perspective on what kind of investing strategies that you're pursuing right now. Like, given everything that we discussed, what might happen this year? Like, what are those strategies? Like, what do you think strong plays are right now that limited partners should consider, given that economic backdrop? Like, should people just be like buying gold and like hunkering down in a bunker somewhere, or should people find some targeted opportunities to be a little bit more offensive offensive minded as we go into 2024? I'd love your perspective on that.
Yeah, absolutely. So I think it's important to focus on, core assets, along with some diversity, and looking at cash flow plays as best you can. There are going to be some development plays that have bigger returns onto them, but the cash flow play, the stability of that long-term cash flow is key. So some of the things that I'm doing, I'm investing in mobile home parks, because I feel like they're recession resistant, and are the lower end of the spectrum on rents, where you have multifamily tenants moving down there, very similar to how you're looking at, class B apartment buildings. You don't want to really want to go to class A right now, because those rents are going to need to drop those renters will go to Class B to get a reduction in rents as well, due to affordability. So being the highest, piece of rental is not a great idea right now necessarily. And so now on the other side, they might be able to afford things more if there's economic swings. $1,000 a month of expense may not hurt them, while it might destroy the really low end of the spectrum, right? If their expenses change dramatically, right? There's less cushion there, I'll say, even though that could be debated. It could be fake cushion in people's eyes and what they present to themselves out there, right? As a CPA, we both know the true financial strength of people is far different than what they present, so and at the end of the day, I think, I'm focusing on that aspect as well as key core operators in multifamily, so that have good quality asset classes, good markets that I feel like I can trust, that have conservative underwriting and things like that, as two core pieces to the real estate aspect of what I'm doing right now. I'm also putting together a single family project and fund, where I'm going to be putting a bunch of properties into one big fund that we're just holding long term from a cash flow perspective, with no debt associated with it at all, which really reduces the risk massively. And we're looking like we're going to be hitting close to a 7 cap from the start, just for those with all cash, just to start, which is enough of a good return with the risk mitigation of not having debt in place to be able to really hold those long term and add to them as the stress happens. Because as in 2008 and 9 and 10 and 11 and 12, when the market was going down during that major crash, which took 6 years to get from top to bottom in that situation, right? It wasn't like a 1 year crash, but
Yeah.
we were buying properties for $30,000 that were worth 100, that needed $5,000 worth of work, and we're getting seller financing on 100% of the deal. And so when there's changes like that could occur in the market, I want to leave things open to be able to acquire more in the future and have, a vehicle to be able to buy more and really gain a significant amount of equity and cash flow to increase those things along the way. So those are some of the strategies. And I'm also utilizing short-term rentals to a degree to juice cash flows as well. So those are some of the real estate related strategies that I'm utilizing, right? And you can see where I'm trying to mitigate risk as best we can with long-term debt on the bigger projects, and then no debt on the single family projects as well. It's a little bit more of a capital raise associated with that type of a project, and it's not live in any way yet. It will be, but the structures and strategies are built to sustain long term, because I learned some lessons from 2008 going, be careful right now,
Yeah.
invest for the long run, and then you can withstand that short-term volatility. Some of the other things that I'm focused on is debt. I invest quite a bit in debt. I really love the fact that other borrowers are putting the down payment money down, and I'm at a much lower loan to value, like 65% of value, giving me equity protection on those assets. So I invest in a lot of debt, and I work with a lot of private investors within those debt things to help fund those loans. We lend to the general public, on fix and flip loans for experienced borrowers. And then we buy paper as well from other note sources and brokers that we work with in different markets around the country, and hold that paper. And our business is we make interest rate spreads on it. We do all the homework on those deals, and then we make interest rate spreads, and we pay our investors a really good return on their capital, and they're able to make short-term interest rate type loans, like 6 months to 12-month type loans, where they can have liquidity on their capital. And I really like notes because they're actually more liquid than real estate. You can literally transfer a note with a purchase and sale agreement and a launch and an assignment of the deed of trust, and
Great
it can
point.
be sold immediately and get your cash without even an escrow company or dealing with all that headache as well. Yeah, you want to record docs, make sure that people are recorded, do your homework. There's a big due diligence package that you want to go through if you're buying those types of notes, but it's really, and including on the property and the borrower. But it's amazing because it gives you some liquidity options to be able to liquidate that paper if you need to. It also is short term to give you more liquidity if opportunity comes up. So it helps you to put your money in a place short term while you're waiting for the market to go down or have a change. But in reality, I'm skeptical that the whole market will go down at all necessarily in real numbers versus inflation adjusted numbers. I think we'll have real estate prices going like this, inflation going like this, and then holding some debt on property is good because that debt gets decimated during inflationary markets too. So I focus on those types of options, the debt aspect, and then some alternative stuff, accounts receivable financing type stuff that has really high returns that I like because it's short term too, and has good collateral options. But as well as I invest in a marijuana farm right now, I invest in other opportunities that are I'm betting on different operators where I don't have to put tons of money in any one deal. I can put 25, 50, 100 grand into each one of these different deals and each one of these different strategies to diversify my portfolio and have some cash flow, some long-term real estate with tax benefits, things like that, right? So
Yeah.
fun stuff to deal with.
Yeah, good stuff, Matt. Yeah, I love the way that you kind of walked us through the thesis of each of those different investment opportunities and how they're strong right now given the current market cycle. And as we start to kind of wind it down here today, I'd love to get a little more detail from you or just around the whole concept of diversification, how investors should think about that before they actually diversify, because there's definitely something to be said for investing in something that you know well. But if you had
Right.
any sort of advice for investors in terms of, hey, look, how can they get out there and diversify without necessarily inviting too much additional risk and, trying
Mhm.
to avoid spraying and praying? Like, what kind of advice would you have for investors to kind of help them to diversify, but to not get too far over their skis?
Absolutely. So the first thing is you should be doing a ton of homework on every deal that you want to look at. And you really should be, not doing 90% of what you see out there. It's really true. There's a lot of bad operators out there that you want to be careful of. So first thing before you decide on any investment type, any investment is analyzing the operator and who they are as a team, as a person, their experience in that particular industry. You don't have to have all the experience yourself in a particular asset class, but you need someone else that does. And it's a really good idea to have someone that already has that experience helping you with checks and balances on the deals that you're investing in. If you don't know that asset class, like if I didn't know multifamilies, I'd go to other people that I know that really do know multifamilies and say, what do you think about this deal? What are the risks I'm not seeing, etc. So before you can even determine, what investments to focus on, you as those deals come to you, definitely ask those questions, learn about that particular strategy. So I think there's a place for active and passive investing. When you're investing actively, you can specialize in that. That's perfect. That's great to do. But I don't want to pretend like, I've owned multifamilies, but I've never owned 350 to 500 unit multifamilies all by myself that I have to manage and deal with. And so I'm going to hire an operator to do that work for me and pay them a great amount of money to do that, but still make great returns. And I love the fact that I can find those operators out there with some homework and some time and some analysis and education to be able to invest with them. And I don't have to go big. I can start off with $50,000 on that one operator. Wait a period of time, see if you see performance. Wait until a year goes by, 2 years go by, see how that works. If you want to wait until they exit the property in 5 years or something like that, then fine. Wait in that period of time. Learn how that works and how that operator operates before you go super heavy with them on the deal. Now that when I say 50,000, that's relative to your net worth, right? So, some people that's too much and 25,000 is more the number if that's available in that investment. Some people have a much higher net worth and they're going to go put 100 or 250,000 or more into those investment types because that's their preferred allocation. And so now you have one, the homework and the operators and taking your time aspect of things, right? You also have the overall picture on what you want in your life as an investor, right? You have to understand, do you want to have direct ownership of property yourself? Like direct ownership of single family homes where you qualify for the debt, direct ownership of multifamilies where you qualify, you do all the work, you hire the managers, you manage the managers. Are you only comfortable with that because you can't give up the control to an operator that's going to do all the work emotionally? That's understandable. And so focus on those types of investments that you can completely control and do all the work for, and focus on. If that's what you feel like you're only comfortable with, then do that. I personally realize that is a hell of a lot of work, like a lot. And you'll lose more money than you will investing with other operators during your learning curve if you don't already have the experience. Now, if you want to specialize like I did in single families, flipping 1,000 houses, like, yeah, then you can go out and focus and say, I'm going to go through my learning curve. I just have to go through this, right? And now I'm going to become a specialist. Great. Just like you guys did in multifamily, right? So you're going through that, you're pushing through and learning that first, right? Now, on the other side of things, do you want to be more passive? Do you not want to be active because you have a job already that you're making enough money on actively? And so do you want to be passive? And what strategies fit you both most? Do you need tax benefits by investing in real estate like mobile homes or multifamily or self-storage or other asset classes like that, where you're going to be in it for a long term? And are you comfortable with that? Or do you really want to focus on short-term high cash flow type options like debt options and things like that that could exist out there, and focus on that? I like both because I don't want to pay taxes, and I want the long-term growth for my wealth building, but I need the income also from the other side over here, because I want to make sure, and just like a lot of investors do, they want to cover their monthly expenses with that cash flow. You can do that from the property side as well as the debt side, and have some extra liquidity on the debt side, while over here you're building super long-term wealth, decimating that debt. And I also like not being when I'm not an operator, I don't have to qualify for the debt. I'm only at risk for what I put into that one particular deal. So that's the things that I would really consider when you're deciding active, passive, how should I be investing? What investment strategies and types should I be doing when you're really trying to develop your own holistic investment picture for yourself and depending on your personal situation.
Yeah, that's awesome, Matt. This has been a great conversation too, man. I always really appreciate your broad perspective on things, and this has been excellent. Definitely a ton of golden nuggets in the conversation here today. And if people want to follow you and what you've got going on at OCG Properties, what's the best way to do that?
You can go to my website at MathewOwens.com, one T in Matthew, so MathewOwens.com, or you can follow me on YouTube at OCG Masters of Real Estate.
Good stuff, Matt. Again, thank you so much for your time today, man. I really, really appreciate it.
No problem. Thank you. Do you want to learn how to create financial freedom in your life through real estate and take your investing business to the next level? If so, you can follow us in one of the following ways. First, you can take one of our free webinars on how to analyze property, how to raise capital for real estate, and how to market and find deals. Three of the key pillars to becoming a successful real estate investor. Number two, you can join us on our mailing list where you'll get tips and tricks on real estate investing directly to your inbox. And number three, you can take our 6-month real estate course that teaches you every aspect of real estate investing you can think of, and more importantly, create financial freedom in your life through real estate investing strategies that I teach. If you want a master's in real estate in 6 months, this course is for you. We're going to go over how to raise money, promissory notes, syndications, fixing and flipping, buy and hold investing, tax and legal structures, self-directed retirement accounts, financial education, how to run a business, how to market and find your deals, and most importantly, how to create that financial freedom in your life so that you can stop trading your time for money and create passive real estate cash flow that you can live off of. If you're interested, go ahead and click on one of the links below, and I look forward to seeing you guys on the other side.